This is King World News. I'm Eric King, and you are about to hear an outstanding interview with Bill Fleckenstein of Fleckenstein Capital. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we will also have Peter Barrons, CEO of Silver Wheaton, as well as Gerald Celente of the Trends Research Institute. And where next week we will have Dr. Marc Faber, author of the Gloom Boom Doom Report, and Bob Quartermain, Chairman and CEO of Silver Standard Resources. Joining us now is Bill Fleckenstein of Fleckenstein Capital. From your piece, July 23rd, 2007, considering that this environment teeters on a massive edifice of leverage, illiquid concocted securities and derivatives, I cannot imagine a more dangerous time to be bullish, end quote. The stock market, Bill, never really went any higher, and because that was at 14,000, and set up for the collapse that would start just a few months later. We've had this tremendous bounce back in the stock market, and last month when I interviewed you, you weren't short anything, and you said you were too afraid because of all the money printing. The day we did that interview, actually the market was at the 8,200 level, and the market closed Friday almost 1,200 points higher. So great call and way to steer clear of getting hurt by Bernanke's money printing press. What are your thoughts on this month, Bill?
Well, I think that it's easy to look at various different stocks and say, boy, that seems like it's really priced for a rosy scenario, and I don't think that's necessarily going to happen, and be tempted to short individual names, especially since so many of them have run so much of it more dramatically than the market itself. I think it's still a little dangerous to try to take the other side. I could see how lots of different stocks could easily drop 20, 30% and have it be no big deal in terms of necessarily a big change in the direction, but the money printing that's going on still bothers me. So, I mean, I think we're about due for some sort of a pullback. It's gotten so stretched, and, you know, we're starting to see a fair amount of giddiness. But the money printing has made some problem more tolerable in the short run, especially those in the financial industry, and some companies with bad balance sheets have been able to repair the balance sheets. But I don't think much of this has changed the underlying economic inability to create jobs and the overhang of real estate and bad credit in the financial system, et cetera.
From your piece on February 16, 2004, what we are witnessing is the unfolding of a dollar crisis. Along the way to full-blown crisis, the steps leading up to it may either pass unnoticed or prompt insufficient concern. That is the story of the dollar. The inevitable crisis will inflict damage, but those who see where we are headed can protect themselves beforehand, end quote. Bill, last time we interviewed you, you said the dollar would be destroyed over time, and that might mean just a big devaluation, not necessarily total destruction, but you have sounded an alarm bell for many years about the U.S. dollar, and you outlined in that 2004 piece the 7-step process of creating a full-blown crisis. Where are we at this point? Because we were in step 3 when you wrote that piece. Where are we now? Which step?
Well, I still think we're in step 3. If you look at the dollar index, when I wrote that, the dollar index was, around 80, 89, something like that, right? And that year, we ended 2004, the dollar index was about 80. We then had a bounce part of 05, and then as 06, 07, and 08 unfolded, it started to look like maybe we were headed to perhaps the stage 4, where the dollar, started testing everyone's resolve and resuming a decline, even though the central bankers had, sort of started to jawbone it. But when we had the financial crisis and all of the unintended consequences of the world, the implosion of almost the whole worldwide financial system, the dollar staged a massive rally, where the dollar index rallied from 70 all the way back to 90, and then has subsequently started to slide again. So I think the financial crisis perversely helped the dollar for things that have nothing to do with the dollar, and that sort of prolonged this sort of step 3, and we're still in it, even though maybe we took a peek into step 4, and so that's kind of where we are now. I mean, the next step will be the dollar start to decline again, and the central bankers won't be able to jawbone, and they'll have to start doing something about it.
This was from the Office of Management and Budget Treasury Department. Tax receipts driven by big drops in individual income and corporate taxes are on pace to post their biggest single-year decline since the Great Depression, with individual tax receipts down 22% and corporate taxes down an astounding 57% year over year. As you know, Bill, California just cut its budget $19 billion, and this will be a trend now across the United States as state coffers are empty or in many cases deeply in the red. Yes, the stock market's rebounded tremendously, but this is where I'm heading with this, what kind of real recovery can take place in this environment with those kind of spending cuts across the board from various states? And let's not forget company layoffs and business closures and commercial real estate problems and on and on. So here's my question for you. As Washington keeps printing money to feed into the system. What kind of recovery are we going to see in reality with that type of backdrop? And isn't it taking nearly $4.50 of money printing these days to create $1 of GDP growth?
Well, I think that we're not liable to get anything in the recovery department that any of us who've seen prior recoveries would call a bona fide recovery. I think that we're liable to see stagflation. For some time, I thought that stagflation was the best we could hope for in the next 3 to 5 years. But the money printing will go on, and at some point we'll start to see inflation in a way that's not deniable. But I think businesses will still not be doing all that well. The job creation will still be on the anemic side, and that keeps pressure on the Fed to stimulate, for the government to try to come with stimulus packages, because I think unemployment is going to be a really tough problem to tackle. There has been an increasing trend to throw more debt at the system, if you will, for some time now. As you point out, I think it's actually more than $4.50 of debt to get $1 of GDP growth. But any number you looked at that was in the last 6 months would be, warped to the high side, of course, because of the, extraordinary amounts of debt that have been thrown at the economy. And, of course, we still don't have much to show for it. So the point is that an increasing amount of debt to try to drive $1 of GDP growth. And we have been relying on too much debt for, a couple decades now, progressively larger more. And what has been viewed in the past as liquidity was really just leverage. A year ago, I guess it was a year and a half ago, at the height of the LBO nonsense, people were proposing $100 billion LBOs, and there was so much liquidity, supposedly. Well, it was just leverage. There wasn't too much liquidity. And I think the stock market rally that we've seen has caused people to drop their guard and become more optimistic. And I think that beneath the surface, there is still plenty of problems, and there will be potholes along the way. And I think that the bulk of the stock market rally we're going to see probably is pretty much taken place. So nothing. I'm still not tempted to fight it.
The press just recently reported that CalPERS, California's huge government pension fund, is the world's biggest public servants pension fund. It has reported an annual loss to June 30th of 2009 of an estimated roughly $57 billion. That is 1/4 of its investment portfolio. The huge loss at the California Public Employees Retirement System is the second in a row for the country's largest fund. A year ago, CalPERS reported a U.S. $8.5 billion loss. Public servants in California will face a drastic cut in their retirement benefits. This is nationwide. Public servants' pensions have been mauled by the falls in real estate and stock markets. What American public servants are now beginning to experience is what millions of Americans have dealt with for some time now on a daily basis. This is a huge shock to them. Most join the public service for an assured job with an assured and generous pension at the end. Now that prospect is being snuffed out before their eyes. Now the pensions promised in future are going or gone, end quote. We just talked about the large spending cuts in states affecting this economy, but what about these pension shortfalls? Would you mind talking about this, Bill? How bad will this be over time?
Well, I don't know who's going to get penalized. I mean, I don't know who has the votes, if you will, in terms of are they going to cut back some benefits that might look to be overly generous, or are they going to say, well, we made that deal and we can't cut those benefits and we're going to cut future benefits? It's not clear to me. It might be future benefits that get cut. But in any case, there are going to be a lot of adjustments when it comes to how people think about retirement, I believe. In the wake of the Depression, when we saw the business in America do so well, certainly in the 50s and 60s, one of the things that people demanded were strong pension benefits, right? We had defined benefit plans. And, of course, those liabilities got to be too much. In the 80s, people clamored for defined contribution plans, right, because they wanted to invest in themselves, and the corporations didn't want the liability. And now I think at some point down the road, there's going to be a huge demand for some sort of safety when it comes to employment benefits. That really hasn't changed much, but I think as the situation becomes more dire, as you point out, I think maybe people will really demand that if they can get it. But those pressures, whether it's Social Security or employee benefit plans, is just going to be more reason to put more pressure on the Fed and the government to stimulate. I mean, the pressures are going to be so overwhelming for the Fed to print money and the government to stimulate from all these different vantage points. It was only 3 months ago when we had a halfway decent employment report before we had two disastrous ones that the fixed income market was pricing in a Fed tightening. As Paul McCulley said recently, who's very close to Ben Bernanke, the Fed's not going to 2011, and I think that's probably right.
You just wrote in your most recent piece that sugar hit a 26-year high and talked about Dr. Marc Faber's most recent gloom, boom, and doom report and stated, quote, he, Mark, makes the connection between the policies we are pursuing, massive stimulus to create inflation due to the fear of deflation, and the funding crisis that I've warned about that will arrive as the U.S. has trouble financing its increasing debt, end quote. We'll get back to Marc Faber in just a minute, Bill, but what about the funding crisis you have been warning about where the U.S. will have trouble financing its debt? Would you mind elaborating on that a bit?
Sure. I mean, the pressure is going to be there, I believe, for the Fed to print money, and I think that's going to continue to take a toll on the dollar. And